Howdy, Jacob here. Today we're looking at Ulta Beauty in the special retail industry, 21.8 billion market cap on 21.0 billion enterprise value. The company was incorporated in 1990 and they sell specialty beauty, so private label beauty products including cosmetics, fragrance, hair care, skincare. I know they recently set up a deal, I believe, or I don't know. I believe they set up a deal with Target since all the targets I seem to go into, they're also there. The growth here looks absolutely astounding. We see that it looks like their reporting seems to be a year early, so this 2021 is still likely COVID, and they've just been grinding 21% year over year, 21, 23, 21, 14, 10, 40, 18, 9. I'd be really interested to see, especially retail or just retail industry in general. You definitely got to look at same store sales, see what they are year over year. But it's the thing that's also nice about retail is that they can just, if they are a very popular store, like if we're thinking McDonald's decades ago or Chick-fil-A a little bit ago, it's so easy to just put down a store or Starbucks. You put down a store and then your return on that investment is humongous. And so there's something great about technology companies and consulting companies where return on invested capital is just innately low. The retail investment, if you are a really good company and you place a store down and you're really good and you get that money back in 3 to 5 years, it's really easy to just keep adding more stores, keep adding more stores. And if your demand still keeps it, Chipotle is another one. So I feel like this to me is one of those retail stores where I feel like if they can keep same store sales increasing at like a 3 to 6%, so maybe with inflation a little bit above inflation, and then add 3 to 5% more stores a year for the next 7 years, 10 years, 15 years, I don't think that's unreasonable. And I mean, maybe for the next 15, 20 years, that's unreasonable. But 7 to 10 years is very reasonable, I think. I think there's a lot of locations for them to go to and people that require makeup. I don't think that's going away anytime soon. I know personally I don't use any, but beside the point. Um, I know a lot of people do. So the margins going up 2% on operating side, 4% on gross margin side. Those are great margins there. 15% is fantastic. Return on invested capital is absolutely amazing. But again, keep in mind that when you buy back shares, you inflate your return on invested capital. And so, uh, since return on invested capital is based on the balance sheet, when you buy back shares, it deflates the shareholders' equity portion. When in reality, the shareholders are getting that money through what should be an increased price, all else equal. And so, these are likely inflated due to them buying back shares, but still just absolutely immense return on invested capital. This would mean that they put a store down in 2.5 years, they get their money back and they can do another store. And that's why, again, retail can be a pretty great investment. The one thing about retail, though, they have a lot of capital leases, and we see that here, 1.6 billion, but they do have 767 million in cash on hand, no short-term or long-term liabilities. So it's really just their capital leases as their interest-bearing debt. Pretty impressive increase in shareholders' equity, even with them buying back as many shares as they have. So that's also very impressive. The use of capital is a little bit of reinvestment, maybe not a whole lot. Call that negligible. Essentially, they're just buying back shares. So you really want to make sure this company is buying back cheap shares. But again, what can work with dollar cost averaging share repurchasing companies is that you really just get the return of the business. And so if the business is actually growing at 12, 13, 14, 15% over a 10, 20-year period, and you just buy back shares a little bit here, there, you're just going to get the return of the business, which I'll take 12, 13, 14, 15% all day. Especially just innate growth, not even like buying a cheap stock. You're buying a great company that's, increasing its shares like that. That's a very positive sign. And so, but again, you get a better return if you buy the shares cheap because they're using part of your money invested in this business to do that. And so if the shares are actually going to give you a 5% return on your investment, that's a pretty crappy return. I mean, you can get that on a risk-free rate right now. So you definitely want them to be buying back shares cheap, but again, if they are just dollar cost averaging, they'll buy when it's high, buy when it's low, it'll average out to the business. And if the business is performing very well, then they will do a great job on that investment. Let's start getting to the assumptions here for revenue growth. I mean, again, I don't think I'd be surprised if same store sales increase 3 to 5%, and then they also increase their store count 3 to 5%. The goal with retail is you want to add more stores to see, if you can get that great return in 2 to 3 years, whatever. But you also want to be efficient with your businesses. So companies that retail locations that have been around for 5 years, 10 years, whatever, and have just not done anything for you, you do want to shut those down. Shut down the inefficient ones, and then keep reinvesting back into the locations that are really giving you the good money. And so I think 8% probably seems pretty reasonable to me. I think at the end of 7 years, they'll, let's see what type of revenue we'll be looking at here. 19 billion, that's pretty substantial. I don't necessarily know exactly what the private beauty, the beauty retail size is, but I presume that they're a pretty substantial amount of it. And I do think 18 is fair due to them having a pretty solid moat, I would say, in which you can see from increased revenue, increased margins, increased return on invested capital, and the fact that they'll probably still have growth a little bit above the market. I'd maybe even consider 20 here. For the margins, it has been increasing. Let's do 10, 11. I think I'm fine with that. Well, actually, get rid of crazy year. Yeah, let's do 11, 10.5. Share change. Their current market cap is roughly 22 billion. So 2% would be about 440 million. With their stock-based compensation, I think that sounds very reasonable to me. Maybe even 3%. 3% would be about $660 million in aggregate. And I mean, yeah, they can afford that based on their last 5-year average. So that would still leave about, what are we seeing, 30% of free cash flow to reinvest, make acquisitions that make sense to you and whatnot. I think I'm pretty comfortable with that. That gets us to a price that needs to fall 22% before we get a 15% return with these assumptions. Yeah, I think we're not far off. And I do actually remember looking at this company when it got down to this 370, and I think my buy price was pretty close to what I'm getting to, probably pretty close to this 350 that I'm showing. But I don't know. I don't think I actually did more research on it though, so it must not have been actually within 10%. But honestly, 20%. This is a great company. I still think there's a lot of growth out of them. I don't see makeup going away or any sort of beauty stuff going away anytime soon. And I think they're the type of retail that's just increasing stores, increasing growth, and it's pretty impressive. So not too much longer, hopefully, until it drops, and then we can do more research and maybe get some. So hopefully you enjoy the video. Have a great day. Thank you.